Welcome to the new year, and we are here for our fourth quarter investment market review and outlook. Hope you all had a good New Year's and the 17 days into the year start off well. So it is Friday, January 17th. Want to make sure to get this out before we have a turnover in the president, and hopefully we don't have any surprises next week. But either way, you are in good hands, and we've got a portfolio set up pretty well and are going to talk about a few additional changes that we're going to be making here in a few minutes. So let's jump right in. So, speaking of our topics for the day, we're going to start with looking back at 2024, see the investment performance across several different areas, and then we're going to go through some headlines and some reasons to be bearish or negative, I guess, as we look ahead to 2025. But then also to counter that, just to talk about 4 reasons to be bullish. We try to be agnostic when it comes to are we bearish or bullish, kind of let the data lead us where we are. There's the reason that we are saying there's 4 reasons to be bearish and 4 to be bullish, because right now I think it can go kind of either way as we look ahead to 25 and beyond. But with that in mind, we're going to talk about how are we changing portfolios for 2025. So let's start with the performance as we have here. This is looking across all the different asset classes, and I'm just going to read from the highest performing down to the lowest for 2024. So for the year, gold did the best, actually up almost 27%, followed closely behind by the S&P 500, which are the largest 500 companies in the U.S. Then down at 16.5% was the total world index. And so we like to use that as a proxy to see all stocks that you can buy all across the world, US, international, emerging markets. I think there's even some frontier markets in there. That was up about 16.5. And that's what we mean when I talk about the market overall. A lot of people talk about the S&P 500. We want to take the whole global market because that's the investable universe that we have. So that was up about 16.5. 14% was mid-cap stocks in the U.S., and then at 11.54 was the Russell 2000. That's small cap stocks in the U.S. And then the laggards for investment portfolios, just developed markets as a whole, was only up 3% for the year. And then bond markets were only up, including interest, only up 1.38%. And it is an interesting, you kind of see this on the chart. We're going to see a little bit more here in a minute. Markets did peak in, for the most part, in November, and December was a pretty bad month. So I already have had a few clients reach out and talk about, hey, my December statement was really off. Where did that come from? Well, as you can see here, this is just looking at December, same indices, same ETFs that you can buy. And you can see that, there's some pretty bad returns. Small cap stocks were down the most, down 8.4% in the month of December. The best performer was gold, only down 1.5%. Again, followed closely behind with bonds. So as you look in December, if you compared your November 30th statements to December 31st, you should have seen, no matter what you're invested in, you would have seen some drop in the markets, and that was driven by several different things we're going to talk about here in a minute. One is interest rates. So interest rates, this is looking out for the whole year last year. What happened to the 10-year Treasury rate there at the top chart and the 2-year Treasury rate there at the bottom? You could see that it does move all across the board. And you see this actually is through today. But if you look towards the end of 2024, you did have rates start to come up. And that mostly was driven actually by inflation expectations. So inflation picks up, the longer term rates, the 10-year rates start to go back up. So you can see that everything kind of bottomed out there in October rate wise, and then had this sharp turn back up. And the concerns in December were mostly around inflation and that the Fed is going to stop lowering rates. So the Fed only has control over short-term rates. And then you see some reaction on both the 2-year and the 10-year, depending on GDP growth expectations and inflation expectations. We're going to talk about all these things here in a minute as it relates to what do we do for 2025. But the explanation for the December 2024 performance being so negative is really rates picking up because of inflation expectations. So let's jump right in to 4 reasons to be bearish. Bearish being negative or pessimistic from an expectation, mostly for stock market. And there are some good points to all of the both bearish and bullish. We are not predicting one way or the other, but I will say there are reasons to be both, and that's what we're going to talk about. So, reason number one, and the one that I think is most cited right now, is concentration of the market to only the top few names. So, looking at the Magnificent Seven, which are the seven highest stocks, and these are Nvidia, Apple, Microsoft, Amazon, Facebook, Google, and Tesla are the seven that are considered the Magnificent Seven. And you can see that over time, going from 2014 at 9.8% of the market, all the way up to 34.6% of the S&P 500 is in just 7 stocks. That's a pretty high percentage. And, the concern really comes in as you look at it from what does this mean for an index or for the market overall, both S&P 500 and total world, if you have underperformance of just a couple companies out there. So this chart that we have here, this is directly from our investment market outlook, which hopefully you all had a chance to read. And this is just sorting. We've got, I think it's 13 stocks listed here, and then the remaining constituents. So about 40% of the market is the top 13 names, and then the remaining is 61%. If the top 10 stocks by market cap get 0% return for 2025, and the rest of the market meets our expectations, which is around 7%, if you own the S&P 500 index, you would only make 4.5. So 10 stocks at zero means you go from 7% to 4.5% return. If you narrow that down to still the top 10, but they lose 13%. So if they lose 13%, but again, the rest of the stock market is up 7%, you're going to get zero return on your index fund if that's what you're owning. If the top 5 stocks here in the third column, if the top 5 stocks are down 19%, and again, the rest are up 7, you're still at zero. And if the top 3 are down 28% and every other stock is up 7%, you're still at 0%. And so the impact of having so much concentration there at the top is, again, if you're holding an index, where Nvidia and Apple and Microsoft go are really going to determine what the performance is going to be if that's all that you own in the portfolio. And so that's a reason to be bearish, because things are kind of priced for perfection on especially those higher valuation stocks. And if they miss earnings, earnings don't come in as high of growth as people expect, you're going to be concerned that the price is going to drop, and that's going to impact the rest of your portfolio, even though the actual underlying stocks don't underperform. Reason number 2 to be bearish, I'm not going to go too far in the weeds here, but we look at both fundamental, which is kind of the last chart, and technical analysis. And there are some concerns in the sectors I've listed here: materials, healthcare, metals, transports, and semiconductors. Concerns that the technical charts may be turning over. And if that happens, you would expect them to come back down in the short term. And if that happens, I think we can kind of say the bull market is over, at least, or at least taking a pause, and that would affect the overall market, both large cap, small cap, mid cap, international stocks. If all of these do have a downtrend for a period of time, especially at certain levels, we would get actually very bearish. And so it's something to be concerned about, something that we're watching, but nothing that we need to necessarily jump into quite yet. Then we get to valuation. I think that's the other highly cited reason to be bearish, and this is looking at the S&P 500 ratio. So this is looking at earnings for the last year, and then comparing to the current price that you have. And so you can see we're at a 28. It did peak there in 2020, well above 36. That's mostly driven by the kind of the data being really messed up from COVID shutdowns and everything. And so I'd kind of throw that out. 2020 is kind of an outlier. But as we look, this does correspond a lot with the bottoms and the tops of markets. And so 2022 was a bad year. That's when you had lower valuation. Those are moving together as you would expect. Another way to look at this is forward looking, or sorry, Schiller PE, which is looking at cyclically adjusted earnings for the last 10 years and then comparing that to current price. Over time, the long-term average is closer to 20. We are right now at 37, which over the last 10 years is close to the peak that you would expect. The last time we were at these levels was in 2022, which again was a pretty bad market. The beginning of 22 was the worst year we've had on anything that's on this chart here. And so again, reasons to be concerned is the prices that you have to pay to buy into stocks today compared to the fundamental earnings are pretty high, and high both historically and the last 5 years, 10 years, going back 100 years, all those different time periods. We are concerned. And then the last reason to be bearish is return of inflation expectations. So this has started to pick up. We actually talked about this well before this headline came out. If you look at our previous videos, we added in August some additional exposure to real assets and gold, commodities, things like that, all and energy stocks, all with the expectation of inflation returning. And now this is just from last week. This is a headline from a Bloomberg article. Powell signals the Fed's focus has returned firmly to inflation. This is a dramatic shift from just a couple months earlier when the Fed was starting to lower rates because they said inflation was kind of beat. And now that is back in the forefront of everyone's mind. It is something that I will say briefly that the market, although it has reacted to it, is still pricing in lower than the long-term average inflation from a break-even point. So we can look at inflation expectations from what is a bond yield versus a TIPS bond or in Treasury inflation protected security. And right now, the difference between those is still lower than the long-term average of 3%. And so I would argue that inflation is still not really priced into the market or an expectation of inflation. So it's returning, but I think that definitely could change over time. Now let's shift to something a little bit more positive. I believe everything that I just said. I also believe everything I'm about to say on the 4 reasons to be bullish. So number one, let's just use data to drive our investing. Even if you invested only at market peaks, as long as you can hold through and weather through significant crashes, you are still going to end up well ahead of just about any other asset class. If you don't invest, you're going to have cash, you're going to have bonds. If you look at these over 5-year, 10-year, 20-year, 30-year return numbers from the worst crashes that have ever happened. So Great Depression, from the absolute peak, if you bought in September 1929 at the highest price, and then it crashed the next day, you would be down if you held through all of the Great Depression, through all of the 30s, basically until World War II, you would have 86% down. But if you just continue to be invested 20 years, 30 years down, you are still happy that you stayed invested that whole time. And you can see all different time periods. Obviously, March 2000 and October 2007 don't have the 30 or 20-year numbers. But if you look at this chart, just because markets are really high, even if I knew tomorrow markets were going to crash, it doesn't mean that if I look out 10 years, 20 years, 30 years, that I would say, avoid it. Obviously, if we had a crystal ball, we'd love to avoid the crashes. But even if you just invested at market peaks, you're still going to do pretty well in the long run. Reason number 2 is kind of the counter, honestly, to the valuation charts that we saw a few slides ago. S&P 500 earnings are continuing to rise. So this is this is the actual earnings per share that have occurred. And you can see that at the same time the market's going up, earnings per share are going up as well. And so there's a reason that prices continue to rise. It's because companies are making more money than they ever have before. And that is something that I believe a lot of people miss, is that we expect that companies are going to get better at running companies. They're better at their own company. There's better over time, decade after decade. We would expect that companies are better run today than they were 40 years ago, just because there's 40 more years of data and business practices that have been tried out and failed and learned from. And so with all that, we expect valuations to go up a little bit over time, and they should move with earnings. And so earnings are going up because valuations are going up because S&P future earning expectations are also rising as we go through. And another way to look at this is really just looking at U.S. companies and how they compare to others. So before you jump into too deep into the numbers that we have, let's just talk about what ROE is. So ROE, return on equity, is a good way to look at individual stocks and how are they turning the equity, the stock capital that into actual income or earnings that you have. And so return on equity is a really good measurement of how good are they at turning into in profits, which is what the companies are there to do, and you want to invest in profitable companies. If you look at an individual stock, somewhere 10, 15% return on equity is a good stock to invest in. And so this is just looking at U.S. stocks, developed market stocks, and emerging market stocks, and how their ROE has been, and how that compares to the weighting. And this is from Nick Colas at Data Trek Research. Put this together for us. And so if we look at the S&P 500, there at the top, you've got Apple, Nvidia, Microsoft, Amazon, and Alphabet. They make up 28, almost 29% of the S&P 500. Their average ROE is 61.6. Remember, I said 10 to 15 is a pretty good number. They are averaging well above that. And you see Apple 165 almost ROE. That's insane. This is why the prices have gone up. They are incredible companies at turning the equity into profits. If we look at the top companies in the IFA, MSCI IFA, that's developed markets, we've got 5 companies here. Notice they only make up 8% of that index. And so part of the reason that developed markets have underperformed the US is because the best companies, who are also the biggest, who have great ROEs, 39% average ROE for those top 5, that's excellent, but they only make up 8%. So they only have 8% of the effect on that on the index versus the S&P 500. These top 5 have over 29% attribution to the returns that you have. Then even if you look at emerging markets, there are some good names in here. They do have a higher concentration, but lower ROE. But still, overall, there are good companies around the world that are making good money and good profits, and we would expect that translates into a better price and capital gains if you invest in those. And so there's a reason that U.S. companies are overvalued in some metrics to the rest of the world. It's because they're more profitable and growing those profits at a faster rate. So a reason to be bullish is you want to own profitable companies. You're willing to pay a higher price if they continue to grow at really high rates. And then I got to throw in my economist view in here a little bit, and this is looking at GDP, so GDP, gross domestic product. That is looking at the economy as a whole and how the U.S. economy is doing. GDP growth is a big long-term driver of earnings growth, and so we would expect that as GDP goes up, earnings are going to follow, and therefore price is going to go up as well for stocks. So the formula for GDP growth, year-over-year GDP growth, is change in productivity versus the change in labor force. So how good are the workers that you have, and how many workers do you have that are doing a great job, basically, in layman's terms. And the long-term trend, this goes back, this is a 10-year chart, maybe longer. I don't know how long I did this chart. Oh, I remember, back to 2010. The long-term trend is 2.2%, which is actually the current expectation for GDP growth for really the next 4 years. We've got 1.2% productivity growth gains plus 0.9% labor growth. What's interesting, if we compare this to what's actually happened since 2010, is productivity's been way higher than 1.2%. It's been closer to 2%. And then labor has been a lot less. The change in the labor expectation is both demographics and there is an expectation over the next 4 years of additional immigration, which increases GDP when you have more workers. Then GDP goes up. But I want to focus really on the productivity side. So right now, economists are predicting that productivity gains will only be 1.2%. If productivity gains are the same as they have been the last 15 years, then we are going to have much higher GDP growth, which means all the expectations that are in the stock price are going to go up. And one reason we could have really high productivity gains is AI. So you hear all this AI, and that's part of why NVIDIA has gone up so much, and you've got all this focus. If AI works and affects how companies do business, we would expect that their productivity increases much faster than the 1.2%. And so if you see AI actually work, it's going to show up in the mid cap and the small cap companies, not just the large cap companies, because companies are going to have higher earnings. They're going to grow at a faster rate. And that is going to be really good for stocks overall. And I would argue those are not currently priced in because right now, the only ones that are getting the AI bump are the companies that are trying to produce the chips and things like that, not the companies that are actually going to benefit on the back end. But we still have a pretty good GDP expectation. And if you have any change from this expectation, I would argue it's going to be on the upside, not the downside, and that leads to a good time to buy in. So as we look ahead to how we kind of tweak the portfolio for 2025, we are not going to be overly bullish or overly bearish, but we want to be prudent with the investments, kind of regardless of what actually is going to happen. And so I want to focus first. Again, this is pulled from our 2025 Capital Market Outlook that we sent out a couple weeks ago. This is the 10-year market forecast. So as a reminder, every December we look and compare kind of all the factors into every asset class. How is it going to do? What's a realistic expectation for the next decade on an annualized basis? So when you see U.S. bonds 4.7%, that means we expect you're going to earn 4.7% on U.S. bonds per year for the next 10 years. But you can see that across the board, because of such a great year in 2024, that we are expecting in 2025 from today moving forward lower. So the negative year over year change is we expect to earn less in bonds. We expect to earn less in U.S. all cap stocks, expect to earn less in international and emerging markets. Everything across the board, we are expecting to earn less. And so that means that a couple things. So one, we still expect the same amount of volatility. So you're going to earn a little bit less, but have just as much, maybe even more variability in your returns month to month and year over year. It's important to make sure we have the right amount of fixed income and global equity and real assets in the portfolio. But also within those, let's be very intentional about what those risks could be and what would cause us to be off of these numbers. So what is going to happen on the upside and what could happen that would cause the downside, and how do we take advantage of the upside but protect against the downside? So as we go to the main portfolio changes, there are four main ones that we're doing. So number one, we're looking to increase our inflation insurance and really maintain a lot of the things that we did in August of last year. That is energy stocks, real assets, commodities, real estate, natural resources, all the physical goods that are going to do really well if inflation does pick up and is unexpectedly to the high side. We want to have those protections. And I would argue that inflation insurance right now is cheap. It's cheap to buy. We also want to decrease our concentration in the large cap stocks. That does not mean we're getting out of large cap at all. What it means is instead of overweighting and saying we want to have the market portfolio of 82% large cap stocks, let's get closer to 70, 75%. Let's decrease our concentration to large cap stocks and add to an active small cap exposure. So small cap, we have historically had more passive investments, so kind of buy and hold the index. For all the reasons that I talked about, we believe that now is the time, especially in small cap stocks, to add and actively manage. I don't want to own the whole universe of the Russell 2000 when half of the stocks are losing money. They have negative earnings. I want to own the best 100 names of those that are going to do well in the current market environment and have the ability to move in and out as we need to. And so we're going to add to an active small cap strategy. Additionally, when it comes to bonds, we want to be a little bit more flexible. So if inflation were to pick up, we want to be able to not lose money like we did in bonds in 2022, as most people did in bonds in 2022, which is when inflation went up, interest rates went up, price of bonds drops. We want to add more to dynamic bonds. You already have that in the portfolio. That was the best performer in 2022. We want to keep that exposure because that can actually own both international bonds, but can also short interest rates, take advantage when interest rates go up, things like that. We also want to add to TIPS bonds. That's Treasury inflation protected securities. TIPS bonds are a part of that inflation insurance, and also they can have some attractive yields that will allow you to kind of hedge against some inflation and rising interest rates. And then the last, which is honestly the biggest change to what we've been doing before, is adding about a 4% position to marketable alternatives. We are in the process right now of deciding between really two funds at this point. So these are publicly traded mutual funds that we can buy into that have either a market neutral or a long short strategy, so that whether the market goes up or it goes down, you still have the potential to make money because it's really the spread between what you're buying and what you're shorting in the portfolio. I am not quite ready to recommend a specific fund. We've narrowed it down to a couple, but in the meantime, we're going to buy a money market fund with this 4% position to earn some interest. So money market funds are still earning about 4%. So we can still earn some interest in the meantime. And then when we're ready, we've got the cash available and can move that over to invest as we need to. So I went through a lot of things really fast. Hopefully you can stop and start and come back in if you need to. But we will be talking about all this as we move forward for 2025 and have meetings and everything else. But you will see some of these trades. If you're an ongoing client of ours, you'll see some of these trades in the coming weeks as we continue to implement all of this and adjust to the market as it goes through. So hope your year is starting off really well, and hopefully everyone knows how to reach us. Send me an email, give me a call. We'll schedule a meeting and kind of walk through anything as it relates to you and your actual portfolio. So thanks for listening. We'll be in touch soon.